Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Stephen Thomas, and Stephen was born in Central California. He built a career as a director of operations for a Fortune 25 company with annual revenues of $120 billion before he discovered commercial real estate. Since early 2018, he has invested in he's been a passive investor in over 7 multifamily apartment complexes with a total of 1,600 units and valued at almost $100 million. In 2021, Stephen became a full-time active general partner overseeing the company's financial forecasting, property acquisition, and property management of its assets. To date, the company's portfolio has acquired over 19 multifamily apartment complexes in a little over 8 years and total combined value of $260 million, and has gone full cycle on 8 deals. So I'm very interested to find out about those. And sounds like you've raised over $70 million in capital and been able to return to your investors an ROI of between 80 to 100% or an average 35% IRR. In just 2 to 3 years. So, Stephen, welcome to the show.
Thanks, Keith. Thanks for having me. I'm excited to be here today.
Yeah. And I wanted to maybe see if we could start really from the beginning. I know you're in California now. Did you end up growing up out there, or and what led you to real estate?
Yeah, so I'm originally from California. I didn't end up too far down the road from where I grew up. I'm only about an hour north of where I grew up. I honestly, I didn't know what I wanted to do. I had several ideas. I spent a lot of time in college getting my bachelor's degree. When I graduated, I almost had enough units for 2 degrees. That's how much I enjoyed college. Figuring out what the heck I wanted to do, right? I really didn't know. I wanted to do something that was going to be meaningful, add value, something I enjoyed. But I ended up just, going to the university not too far from where I grew up. And, like a lot of people, I needed to start working. I tried a bunch of different jobs, needed to start working, and fell into a corporate career, which is not a bad thing, right? I mean, there's a lot of financial security that comes with that. I needed to pay the bills. I needed insurance. I needed to raise a family, all of those things. But I had the realization I was building somebody else's dream, right? I was working really hard, and it didn't matter how much harder I worked. If I worked extra hard one day and even harder the next day, I might get some accolades. I might get some kudos. I might get an attaboy. I might not get anything. Occasionally I get a promotion, right? Maybe 10, 15% promotion, salary increase with that promotion. And I'm like, I don't know, this doesn't make a whole lot of sense. I'm religiously putting money into my 401k. That's what they're telling me to do. I'm getting the match, and okay, well, I can keep doing this. I'd watch my parents lose money multiple times in the stock market. And I said, I don't think this is for me. Like, I've got to figure something out. So I tried a lot of different things, man. I thought about starting my own business doing car restoration. I grew up working on cars with my dad. I really enjoyed that. I thought about doing like car fabrication stuff. When I was in college, I looked at a lot of different things. Some automotive stuff in college, some physical therapy stuff in college, some engineering stuff in college. I didn't know what the hell I wanted to do, right? But like I said, I just knew I wanted to do something, enjoy doing it. But I remember this one day, right? So your question was, how did I get into real estate? Well, my wife and I, we had decided maybe we should fix and flip houses. Well, house hack and fix and flip, right? So we bought this old fixer-upper and we're living in it. And I had a little kid at the time. But I remember this one day, right? This very pivotal moment in my journey where I was sitting at the kitchen table. It's like 7:00 in the morning. We're working on this huge project for my company, biggest project we'd worked on as an organization. And I have to get this status meeting first thing in the morning. So I'm sitting at the kitchen table and my mother-in-law, she's there helping us out. And she would come watch my son in the morning, and he's 2.5 at the time, right? So she's feeding him, and about as fast as she can get food on his high chair, he's throwing it on the ground, right? He's having a great old time. And about that same time, my wife walks through the dining room and where I was sitting, and I could see her little baby bump. She's pregnant, and it should be this like really magical moment. I've got my family around me, but I'm sitting at the kitchen table, and it's my turn now to give the status update for this call. And at this time, my son, he's in tears. My mother-in-law, I love her to death, but she has 2 volumes, like loud and louder. So she's trying to calm him down, and there's just chaos going on in the background. But here I am, super focused on my career. So I've got this early morning phone call because we're, spread across the United States. And the reason why I couldn't go into like a corner was because my house was in shambles. It was like, holes in the wall. We had done some demolition. There was no place for me to go. And I'm like, this sucks. Like, I am burning the candle at both ends. I'm trying to like fix and flip, trying to raise a family. I'm trying to do the corporate career. I can't do it all. I was like, I got to do something.
Yeah.
So that was really like that moment in time for me where I was like, something snapped and I had to change what I was doing. So then I spent a lot of time, spent a lot of money learning about passive investing in real estate. And where I landed was passive investing in apartment deals. And then I remember getting my first check in the mail. And by this time, my second was born. So I had a 3.5-year-old and I had a newborn, and I got a check in the mail. I didn't do any work. All I did is I just invested. So I was changing diapers, getting mailbox money. And I was like, holy shit, like this is awesome.
Yeah.
So that was, that's a really condensed version of how I got to where I'm at. But it was so life-changing for me that I thought, when things get to a little bit more stable place, I'm going to go this direction, because if other people can help me out, I know there's people just like me. Like, I want to go help those other people. Long story short, here I am, full-time syndicator, enjoying helping other people achieve financial freedom.
Yeah, it's great. And that's an interesting approach. A lot of times people will get into, I guess you did a little bit of the flipping of the house hack and that kind of thing that kind of got your feet wet there. But interesting to jump right into passive investing. Are those people that you knew, through work, or how'd you come across a multifamily passive investment?
Well, it was part of my studying. And I had a friend who was a real estate agent, and I asked him, right? Because like I said, my vision was, I was like, I'm going to build a portfolio of single family homes. And you sit down, you do the math. Okay, well, how much can I make per door cash flow wise on a single family home? You do the math. You're like, okay, well, I have to own 150 houses. Well, shit, that doesn't work. okay, what's a better way to do it? And so he just said, here's some podcasts, start listening to these podcasts. And I came across a podcast where someone was saying, like, I have a program and you can join as someone who just is a passive investor, and there's a network of people who syndicate apartment deals, or you can learn how to syndicate your own deals. And so it was really through podcasting. And what I did is I heard about this event. It was a 3-day event. And I said, I gotta go. Like I have to try. I can't not do this. So I left my wife home with my 2 little kids, and I flew halfway across the country, attended the webinar, and I was like, I'm sold. And I've just been educating myself ever since. So it was not an overnight thing. I had to do lots and lots and lots of research, lots of time on bigger pockets, reading lots of books. But what I needed was a solution where I didn't have to do the work. Like, how can I leverage the advantages of real estate investing, other people's time, other people's experience, and take advantage of that? And that's where I was at.
Okay. And as far as the first one that you invested in after attending that conference, what year was that?
2018. It was 2018 when I did. 2018 is when I did the first passive investment.
Okay. And then, you were in 7 of those different deals. Were those in ones that you invested in just, I guess time frame, you got one, you started getting some mailbox money. When did you get the next? And were you still working, I guess, at the W-2 at this point?
Yeah. No, I was. So the passive investing, there's a lot of nuances that go into passive investing and the cash flow component and the capital gains, probably more than we can get into on this podcast. But I just dipped my toe in the water. Yeah. So with my first one. And so it was a minimum investment of $50,000. And so that was just right. I can risk that because at that time, there was some education that was out there. I had learned about it. I was like, okay, I understand enough to make the investment, but I still don't understand it completely. So I dipped my toe in the water. But it worked out well enough for me, started the cash flow well enough for me that then I said, okay, well now let me accelerate this. And then I started going after more and more and more passive deals. And so I still, even though I'm an active syndicator, I still invest passively in other people's deals, people that I know, like, and trust. So I still invest passively in other deals.
Okay, great. And are the ones that you've invested in, are those all the same sponsor, or do you have it spread out across multiple people, or?
I've spread that out. And what I've learned is that you do need to take the time to get to know who the deal sponsors are. And I believe that because I do a lot of underwriting now, like that's my main focus right now is underwriting. It's really easy to make a deal look good on paper, right? There's a whole bunch of little numbers you can tweak here and there, right? You can make them look good on paper, but can you implement the business plan? And then when bad things happen, how well can you react to that? I mean, right now, what's going on in the economy and real estate is a perfect example of nobody was planning for the things to turn upside down, but a lot of things have changed. And so how do you deal with that? And it's, you do need to take the time to vet the deal sponsors and understand them. What is their track record? And get some alignment there. So I've invested with different groups over time, but I've also taken the time to go out and meet them and meet other groups. Mm-hmm. So it's not all just one particular group. A number of different groups I've invested with. And then what I did is kind of like, think of it kind of like, I don't know what I'd call it, like speed dating, but along the journey, you meet enough people and you start investing with them. And for me, like I said, I wanted to move over into that space where I'm syndicating deals, right? I'm purchasing my own deals. I'm raising capital. I'm helping other people. So for me, the opportunity was aligning myself with other people, getting to know them, seeing what their strategy was, how did they handle adversity. And then I was able to align myself with some of those individuals. We had enough of the core values that we said, well, yeah, we can work together. We can acquire these together, because Keith, I'm sure you can relate. Like, it's a team sport. When you start doing bigger things like this, to try to do it by yourself, so many moving pieces, there's so many mechanics there. It's a team sport. And really what happens, these deals are not short-term deals. They're years, right? I mean, we underwrite for 5 years. Generally, you can get out in a few years, but they could be 7, 8, 9, 10 years. So you're in a relationship with these people for a long time. So to restate that, no, I've invested with different groups. It's given me the opportunity to get to know different groups and find the people who have the values that I really align with.
Makes sense. What, all multifamily, or have you done other asset classes?
Only multifamily. There's definitely some things that I've considered, but I would consider, honestly, I would consider passive investing in other real estate asset classes, commercial real estate asset classes. But for me, where my focus is, I'm choosing to take apartments and go deep with it. And I would leverage somebody else's time and somebody else's experience in some of those other asset classes. Mobile home parks, for example, or storage units, for example. My preference would be to find people and align myself with them, same values. I would be able to understand the business plans, but I'm sure it's a different business model, and I wouldn't want to spread myself too thin.
Yeah, no, that makes sense to keep it kind of in your wheelhouse as far as your investments go. Now, when did you officially start your company, or I guess you joined somebody else's existing company as one of the general partners?
Yeah. So I did. I started working with another group of individuals who had been working together for a number of years. Like I said, but it was through the opportunity of just meeting them, getting to know them, investing with them first, where I was able to partner with them and then start doing deals with them together.
Okay. And as far as the ones that you're in now, or maybe even the ones that you passively invested in, is there a specific geography that you're investing in? I mean, where are these in California? Are these across the U.S.? What does that look?
So pretty much everything we're invested in right now is going to be in Texas. There's a number of other areas. I don't invest in California. I love to live here, but I'm not going to invest here, at least not anytime soon. And so, Keith, I'm sure you probably have some criteria, but we look for things like business and landlord friendly states, right? Where there's population growth, where there's an above average affordability gap. So when you can look at different markets across the United States. It's interesting. I saw an article the other day, and it was about all the migrations, every single state in the United States, if they had a positive net migration or a negative net migration, the number of people that left California almost matched the number of people that went to Texas. So I'm not saying everybody from California moved to Texas, right? But you gotta pay attention to what's going on, like where the trends, where are people moving? Because, for example, you want to end up in a market where when things go bad in the economy, if there's still growth, if there's still natural growth happening within that submarket, you're going to do way better than if you're in the location where when things go bad, you've already got people leaving that submarket, right? Your occupancy is going to go way high, or your vacancy is going to go way high, and you don't want to deal with that. So we're pretty strategic about it. The other thing too is we think it's really important to have boots on the ground, someone who can be there, show up to the property, do the property tours, checking on the properties every now and then. And so we have partners that are spread across Texas, and that's why we're focused in the Texas markets. Okay.
And as far as Texas market goes, Dallas, Austin, San Antonio, Houston, what areas or what cities, if or
yes. Okay. Okay. So there's so we have a lot of stuff in Dallas. We have a lot of stuff in Houston. We have a portfolio in Houston. we haven't really done much with Austin or San Antonio, primarily because we don't have boots on the ground. But we're changing that right now. Part of our strategy is to get boots on the ground in the area. But if you look at a map, the areas you just listed, the Dallas Fort Worth area, down to Austin, San Antonio, and then down to Houston and back up, a lot of people call that the Texas Triangle.
Right.
So that's like the area where we're mostly focused on, is in that Texas Triangle area.
Okay. I think that's very smart. I mean, it's an area that continues to have strong population growth, as you mentioned, and just, great cities as well. So so you mentioned on your underwriting, one thing I was going to ask you on that is, I'm sure the assumptions and the various things, whether it be rent increases, has changed since the market's changed a little bit. First of all, what changes are you making, and what assumptions are you making when it comes to being able to increase the rent?
Increase the rent. That's a very interesting topic, because I've been we looked at a lot of deals over the last few months. We took a step back. We said, okay, we need there to be a little bit of stability. And when I say that, a lot of it is interest rates just shot up, right? The fastest rate increase I think we've seen in the history of rate increases.
It is.
What was that going to do to everything? And what happened is most of the apartment complexes bought in the last 2.5 years, there were variable rate loans. They were bridge debt, because that's how the deals were priced. And so that changed a lot of things. And then you had the inflation on top of that. So as the interest rates were going up, the mortgage payments were going up, and operators were having to offset that by, we got to raise our rents.
Yeah.
But people only have so much disposable income. So what I'm seeing when I look at data, when I look at the real data, feedback from our operating statements, conversations with the property management companies, looking at our occupancy, rents right now, I can tell you for sure in Texas Triangle area, but I think the story is probably same for most of the places in the United States. Rent right now, I think we're about as high as we're going to get for a while. What I'm seeing in industry data, we're expecting a decrease, but a small decrease in rents for the next year, plateauing out a little bit after that, and then looking 3, 4, 5 years out back to industry norms, which are going to be closer to 2%. Now, you have pockets, neighborhoods, they're all different, right? It's important to understand the intricacies of the neighborhood. But we pull industry data. So we use something called CoStar. And it's tied in, basically, it's the same company that owns apartments.com. So everything that's posted on apartments.com, all that rental information, and gets pulled in and aggregated. And then we get reporting off of that. So we see basically what's going on near real time when it comes to rent fluctuations. So my best guess right now is, from an underwriting perspective, rent growth cannot be aggressive. It's got to be pretty stable. And then in the future, it's tough. It's always tough when you get about 3 years out. It's really fuzzy. Who knows what's going to happen? But most of the stuff we're seeing, most of the industry data is saying even in 3, 4, 5 years, it's 2% rent growth is what we're seeing right now. How about you? What are you seeing in the stuff you're looking at?
Yeah, I'm seeing 3 or less. I think that just when you're underwriting it, not calculating, like you said, that you're going to get much growth at all. And so then it becomes, what other strategies are you using to build the value, that kind of thing. So on what you're purchasing, what are the kind of the levers that you're pulling to try to increase the NOI?
Yeah. Well, the short answer is we're saying no to a lot of deals because we got to be smart, right? It's not just my money, it's investors' money. But forced appreciation. So organic rent growth is really not there. Not right now. Not probably for the next 18 to 24 months. I don't think there's much organic rent growth. But you can do forced appreciation where if you have units that you could renovate and it's a higher quality unit that has more amenities within the unit, it's cleaned up, as opposed to the other units that are on the property, then you can get increased rent, but you can't just across the board say, I'm going to raise rents 3% year over year. Right. So we're looking at very strategically properties where there's opportunities to renovate units. We're looking for things, for example, what can we do inside the unit? Is there an opportunity to add washers and dryers? And if we can do that, then we would purchase a washer and dryer. You package it in with the rent. There's an opportunity there. We're renegotiating contracts. Any place we can renegotiate a contract, we're renegotiating them. For example, there was one of our properties, our cable and internet contract wasn't, we inherited it with the property, but it was set to expire the end of this year. Well, I just went to the company and I said, I'd like to renegotiate this now. If I can sign with you now and do another 5 years, can you work with me on rates? And they said, yeah, absolutely. We're happy to do that. So we're basically auditing where we can with our expenses and renegotiating contracts. Maybe we're extending things out a little bit longer so that we can reduce expenses, which helps with the NOI. And then, for example, with the cable and internet one, it reduces our expense, but then we can also offer a better product because we're basically able to double the internet speed for our residents, which everybody likes that. So those are some of the strategies there. You have to be careful with some of the stuff that I see. Some of that's like smart packages or the tech packages where you got, a smart door lock and a smart thermostat. You can do it, but not everybody wants to pay for it. So that your question right there is like the crux of it. Like you can't just put all the stuff on paper and say, oh, it's going to work, because I will tell you, I'm seeing it at our properties. People don't want that stuff, right? You have to be very in tune with what's going on in that submarket. And if people don't want it, just because you build it doesn't mean they will come. So it is tough. It is very tough right now. But I think one of our two major things is unit renovations. Can you do it right? Mm-hmm. And then what can we do from an expense perspective on being smart about negotiating those contracts? That's really what we're focused on right now.
Okay. And as far as the current ones that your company has, and maybe what your future buy box looks like, how many as far as the number of units, what are you looking at? Are you looking at what class of multifamily are you guys focused on?
So for like our current and going forward?
Yeah.
So we've been in the probably like the B- C+ space is where we've been. What we've seen, and I'm sure a lot of people can relate to this, is the disposable income for the C class went away very quickly with the inflation. And so what we're looking at is a nice B class mid 80s to probably 2010 inventory, because there's opportunity to add value. So the strategy is very much value add, right? So where is, right, rather than focus on occupancy, what we don't want to do is we don't want to find a distressed property and say, we do everything right, we're going to hit a home run, because that's pretty risky right now. What saved a lot of people in the last 10 years was really good for a lot of people, but that's because the economy was hot, everything was good, and cap rates were just going down and down and down and down. Now cap rates are on their way back up. So you've got to factor that into the equation. You're not going to just hold on to a crappy property and sell it in 2 years and make money. You've really got to learn to operate it. And so where we see the most opportunity is with a solid B+ property. And that's the area that we're playing in. Maybe an A-, but it depends. Mostly the BB+ area.
Okay. And what about as far as debt? How much debt are you putting on the deals? And has any of that changed over the last, couple years?
It's changed significantly over the last couple of years. So, like I mentioned before, in multifamily space, in the areas we were looking at, the pricing was very competitive. It was predominantly bridge debt, meaning variable rate loans. And that's so everything is based on SOFR. I mean, it was LIBOR. We converted over to SOFR. And that's when rates were like basically near zero at that point. And then there was a spread on top of that. But if you had that same interest rate, I mean, they're at it was probably a 3.5% interest rate 18 months ago, and it's 9.5% now. And so that's just interest on your mortgage payment every month. I mean, your mortgage payment could be more than double what it was when you first acquired the property. And you're like, holy shit. So what are we seeing now is most of those bridge lenders have gone away. I mean, the lenders are still there, but nobody's interested in that debt structure. Very few people are. And so now it's shifted over to fixed rate debt. And so I guess going back to the bridge loans, those are probably leveraged about 75 to 80% loan to cost. So you would have to come in with 25% down. Now, for a little while, it was like 55% LTC. It's shifting now right around over to between 60 and 65, which I think is healthy, right? You don't want to be over leveraged. Yeah. I like truth be told, with everything that's happening with the economy, and I look at it and I speak with brokers, I don't think things are crazy right now. I think things are crazy for a while, leading up to this, but like the pricing, the cap rates, everything should not have been at 3 cap. Like everything shouldn't have been, right? There's actually spread between property classes right now than there should be. So it's frustrating as an operator what's happened, but when I look at it from more of an economist standpoint, I understand the adjustment. Like, I think that we're technically in a good, healthy spot. It's just shocking for everybody because the way the business plans are structured for a lot of people. So, then interest rates right now, on most of them based off like the 7-year, 10-year treasury. At least the stuff we're looking at because of the time frame we're looking at. And those are probably, like I said, they're leveraged probably between 60, 65%. And then what we're seeing is a little less than 6% on the interest rate, but that would be fixed at this point as opposed to variable. There's different strategies out there. You can get into floating rates. You still can. There's rate caps you can buy, which is basically an insurance that you pay a premium so that there's a ceiling on the interest rate. But those are crazy expensive. So, for example, one of the properties we bought about a year and a half ago, the interest rate cap for that property when we got under contract was about $40,000 or $50,000. By the time we closed, it was $200,000. That was for a 2-year interest rate cap. So I get the email every day that says what the value is of that interest rate cap. Today, where there's like 6-8 months left on that, the value of that interest rate cap is like $600,000-$700,000. So yes, so for me, so yes, I can go get bridge debt, but the lender's going to require me to get the interest rate cap. And it could be $1 million or more. At one point, that same rate cap that was leading up to the spike in interest rates, it was $40,000. At one point, it peaked. It was over $1 million for the same interest rate coverage. So, I mean, you've got to understand those nuances. You got to be careful with that. But because of that super inflated insurance premium to put the ceiling on your interest rate, most people are steering clear of the bridge debt completely, and they're just going for fixed Fannie, Freddie, like I said, over the 7-year, 10-year treasury. So that's what we're seeing right now.
Okay. And then as far as like your focus on multifamily, I like the class that you focus on. I think there is a lot of value in that. There's plenty of opportunity to update the units to just make them more attractive for potential tenants. But what size are you looking at as far as number of units? Or you pretty open there? Do you know, if you just look at your current portfolios across the board, or certain size, or what does that look like?
Yeah, the size we're looking at is somewhere between basically, I'd say 125, 225, 150, 250. And the reason for that is when you get larger properties, you get professional property management, right? So definitely for sure anything 60 or above. But strategically, when it comes to operating a property, whether you have a 30 unit property or a 300 unit property, you basically do the same work.
Right.
So, right. You have to, when you acquire the property, you've got to do the same amount of paperwork. You've got to get the same legal team involved, right? You've got to do all that same work. You still have to, meet with a property management company. So if you're going to do it, why not, be as efficient as possible and go for something as large as, makes sense. So when we teamed up with the property management companies and we start talking with them, right, talking about efficiencies, their feedback to us is, look, I've got to staff a property, right? I have to have a full-time property manager. I've got to have maintenance teams. I got to have leasing agents. And they came back and said, look, if you like a sweet spot, right, of the property management companies we work with, that sweet spot is somewhere between probably 125, 150 to 225 and 250. That's where you're going to get a lot of efficiency there. There are larger apartment complexes out there. There's 300, 400. They're really big. And there's even more efficiencies or economies of scale out there. But then you kind of start competing with institutional buyers. And those might be like some of your REITs or things like that. And I know, and I'm getting a little bit out of my comfort zone here when it comes to REITs. I know I think they do some residential single family, but in my conversations in the circles I run, and once you get to the really, really big stuff, you have banks that are involved, you have REITs that are involved, and they're really, really big. So what we found is understanding economies of scales and efficiencies and feedback from property management teams and our experiences were in that range of property size.
Okay. All right. And then what about, do you have a single property management company that you work with on all your Texas properties, or is it kind of region specific, or what does that kind of look?
Yeah, that's a fantastic question. And a little bit of a story to share with that. So the short answer is we don't put all of our eggs in one basket. We work with different property management companies. So part of that is just regions, right? So as we're looking into a new market, we might need to find a new property management company to work with. But I had an experience where we had taken over a property, and within about 3 months, we got a notice that said, hey, property management company reached out to us that we're dissolving. We've got like 2 to 3 weeks until we're done. We're dissolving. And it was like, then there was a hurry up and scramble and figure out what was going on. So the learning lesson for me was, you got to be a little bit diversified, right? If you lean too much into one vendor, one partner when you're doing those things, property management company or insurance company, whatever it is, you need to have, I'm not saying that you need to go have, 20 different options out there, because you do get, when you partner with property management companies and you work with them a lot, they appreciate that. They respect that, right? We will get a lower property management fee. And so we want to respect that relationship. And if it works well, but at the same time, you've always got to have a backup plan. I've learned some of that through my corporate experience, is just when you think things are going great, guess what? The rug gets pulled out from underneath you. You've got to go scramble and figure things out. So yeah, a bit of both, right? We need to, as we're in different markets, property management companies generally not spread across the entire state. But yeah, we got burned got burned before, and we learned our lesson on that one.
Yeah, it's a tough gig. I mean, there's the margins are so thin on property management that it doesn't surprise me that there are companies that are just going to call up one day and say we're going out of business, we're dissolving.
Yes. And it was fast, and it was not like here's another plan.
Yeah,
if you'd like to absorb the staff, it was like we're done. And then what happened is the staff basically got noticed at the same time we did. And it was like rats jumping off a ship. It was an ugly situation, but we're better for it.
Yeah, for sure. And then how can people find out more about your company? Give us a little bit of an idea as far as you work primarily with accredited investors. Maybe talk a little bit about if you have any current offerings, what minimums you have as far as the smallest type of investment?
Sure. Yeah. So the partnership group is Sustainable Capital Investments, just like it's spelled. You can find us on the website, check out our portfolio, learn a little bit more about us. We're big into education. So we've been building out a resources library. We do a once a month educational webinar. And so that's one of the things we really try to add value is I know what it was like to get into it and not know much about it. It took a lot of learning. And if we can help people along the way, like here's the things, lessons we've learned, things that you want to pay attention to. We want to make that available for individuals. So we're big in education. As far as accredited or sophisticated investors, we work with both. All of our offerings are, I can never remember which is which, but the 506C, which it's a B. I can remember it's A or B, it's B or C, but we open it up to sophisticated and accredited investors.
Okay.
So what that means is we don't solicit outside of the current relationships that we already have. And so that's the approach we take. And we've looked at doing it both ways, and I've talked to people about doing it both ways. It just kind of depends on the direction you want to go and the investors you want to work with. But even if you work with just accredited investors or sophisticated, there's pros and cons to all of it. But so we're open to anyone that wants to invest that's qualified. So we would need to meet with you, understand you, your financial situation, your level of sophistication. When we have an offering, you have to fill out paperwork. If you're not accredited, you have to show that you're sophisticated. Like, what is your investing experience? What does your existing relationship look like? But what we like about that is it gives us the opportunity to build a relationship, right? Is it the right fit for you? Are we the right fit for you, right? Because I think of it all the time. Like, I mean, I used to interview a lot of people in my corporate job, and I would tell them, I would say, hey, I'm interviewing you, but you need to be interviewing me. You need to make sure that like you want to work for me. Like, can you show up every day? And do you like my attitude? Do you like my approach? So honestly, I'll tell, potential investors, like, get to know me, make sure that you like what I'm doing, because if you don't, like, you're in this investment for a while and your money's locked up until we're out of this. So I like that conversation with them. Minimum investment amounts, because we're raising 10, 20, $30 million. Our minimum investment amount is typically 50,000, maybe sometimes 75,000 is our minimum investment amount there. But like I said, when you're raising a lot of capital, you don't get there $100 at a time. You work with people that are able to make a good investment, but it also doesn't pull all of their liquidity out and leave them in a bad spot.
Right. That makes a lot of sense. What, as far as communication and as far as distributions, you do quarterly distributions? What type of communication outside of like maybe the educational pieces, and what kind of updates do you provide your investors?
So we do, at a minimum, we'll do a monthly newsletter. And the newsletter is basically an operational update. We have KPIs. What's the occupancy trending like? We do high points of income, expenses, NOI. And then we do a bit of a story of like what's going on in the operations. Like, so this is the reason why occupancy looks the way it does. Here's a strategy that we're putting in place. Here's some of the things we're doing to decrease the expenses. So we have a narrative that goes along with that. We also provide, as part of that, we provide all the financial reports. So every month we download and save and PDF the financial reports. So we give we try to do as much visibility into the investments as the investors would like, right? So we give them the narrative of what's going on from an operational standpoint. We give them the KPIs they can check out. And then if they really want to dig in, we have all the data for them. And then we'll always make ourselves available for a phone call. What we find is with that communication right there, most people don't pick up the phone and call me. But one of the things I love about this type of investment, as opposed to my Fidelity investments, is someone can pick up the phone and talk to an owner. Hey, help me understand this. What's going on? What's your strategy? Where is if I have the money that's in my 401k and I'm not happy with what's going on in the stock market, I can't call up the owner of the company and say, hey, I'm not really happy with the way your stock's performing.
Right.
What is your plan to increase the value of the stock, right? What is your plan to increase the diluted earnings per share? Whatever that is, right? I can't do that. The best I can do is talk to an analyst that says, well, maybe you need to change your investment strategy. And so that's one of the beautiful things I love about it, is I've always been able to build a relationship with the people who I'm invested with. And yeah, was there another question in there that I hit on? That was basically, what was the communication aspect of it?
Yeah. What about the distributions?
Distributions. Yeah. So typically what will happen with a multifamily investment is we will always do quarterly distributions. And I'm going to give that with the caveat, as long as the property is cash flowing. What we're doing with our properties right now is we know that there's uncertainty. And so our biggest concern is we don't want to end up in being cash flow constrained. So we're honest and we share that information. Like, here's where we're at. Our guidance is that we hold on to cash because we're in for a little bit of a ride. When it's appropriate, we'll make distributions again, right? I mean, I just opened Kimono. That's the reality of it right now. When things stabilize a little bit, we'll get back to quarterly distributions for that. Typically, most investment, what happens is you take over, you got a new property management company, and then you have to implement your business plan. That could be unit renovations, it could be decreased expenses, other income. That doesn't happen on day one. You've got to go in and implement some things. So typically what you'll see on these types of investments is they don't cash flow day one. You don't get distributions the first quarter, but within about the first 6 months, then generally, and I can tell you, like, probably almost every investment I've done from a multifamily perspective, I don't know that I've ever gotten anything before the first 6 months. From that point on, then it turns into a quarterly distribution.
Yeah, it makes sense. I mean, anytime you're doing value add, there's going to be there's going to be a spend period before you have to start expecting to get some of that back. So makes sense. What outside of when you're not investing in real estate, you mentioned you have some kids, you got a wife and kids, and what do you do outside of doing work?
Well, work is a lot. I enjoy work. I really enjoy work. So I do spend a lot of time at work, but when I'm not, it's pretty much family time, which I really enjoy. I shared the story with you earlier where I was spread super thin. I remember when I had that house and I was flipping that house, I consciously was making the decision to not go hang out with family and friends because I always had a project to work on, right? I was like, I need the contractor to come. I've got to work on this. I've got to fix this, right? Like I had bought myself a job and I didn't have the free time. And so now I'm very structured with my time and I always make sure I'm spending time with family. So my kids are young, they're 8 and 5, so they're just getting into sports. So we're letting them try out a bunch of things, which is really fun. And we hang out with the family. So here next week, going to be spending a week with a couple of my sisters, my in-laws. We're going to be out of town for that. We've got some other vacation planned, a couple more trips planned later this year. So just really focus on like enjoying life and that free time. But it's very much family and friend focused right now, which is a great spot to be in.
That is a great spot to be in. All right, I got 2 more questions for you, and then we'll let you go. But how about any book recommendations? I always like to ask. I'm more asking for myself than the audience, but always like to hear what people like out there.
You know, there's a lot of books out there. Just one. I just one book recommendation, or I can give you a couple.
You can give me a couple.
All right, let's go with a couple. So one of the first books I read, there's a cash flow quadrant, and there's Robert Kiyosaki's Rich Dad Poor Dad, right? So those are famous. But there's another book I read, which is Think and Grow Rich by Zig Ziglar. And that was all about mindset. And that was probably one of the first times I read a book that was really what you put your mind to, you can change your outcomes by really putting, just not giving up. So that's probably one right there. And then the most recent one I've read is Ed Mylett, The Power of One More. Mm-hmm. I'm a big fan of Ed Mylett. He's got a lot of good things to say. But the message in that is you're one opportunity away, you're one decision away, you're one action away from changing who you are, changing your trajectory. And I think we can all do one more thing today, right? I think we can all make one different decision today. And when you start adding those things up, that's when it moves you in a different direction. So those would probably be my top 2. And you can probably pick up on the theme from that. I'm a big believer on mindset.
Yeah.
It's this space, I'm sure you can relate. Especially being a business owner, there are great days, there are really bad days. And you, in this position, you're helping out a lot of people. You have a lot of people's money on the line, right? So I think mindset is huge because when things get thrown your way, you can react to them viscerally, or you can pause and you can say, how can I make the best out of this situation? And so I think that continual reminder of growth mindset and always becoming better, I think it helps out a lot when you're looking at your day-to-day business operations. So that's where I like to hang out, is in the mindset area.
Yeah, I like it. I like it for sure. And on the Think and Grow Rich, it's Napoleon Hill, not Zig Ziglar.
Napoleon Hill.
Yeah, just in case somebody tries to look it up. So
I appreciate that. Thank you for clarifying that.
Yeah, no problem. Hey, and then one last question for you. How about, any advice that you may have for somebody? I think you're in a unique position in the sense that you did a lot of passive investing, which our audience is, high income W-2 professionals that maybe they don't have time to get their hands dirty, but they've heard about real estate. They love real estate. Any advice that you might have for somebody who's maybe starting that part of their journey?
Yeah. For me, I had to make a little bit of time, right? I was busy, but I had to make time to surround myself with those right people. So it's like with anything, you don't just wake up and you have a new job. Like you don't just wake up and you're in a different position. You have to put in a little bit of effort. So probably my biggest piece of advice is plan on spending a little bit of time. You don't have to spend a lot. Plan on spending a little bit of time doing a little bit of research. But what I did is I went to an event where I was surrounded by, all of a sudden I was in a room full of multifamily syndicators. Mm-hmm. I went from not knowing anybody, not knowing anything about, multifamily investing, to being in a room full of people who are multifamily investors. And it was, within 2 or 3 days, like my whole mindset changed. The context I had changed. So with a little bit of research and then just committing to, I'm going to block off a weekend, right? A couple weekends here, a couple weekends there, but you've got to put a little bit of time into building some of those relationships. And you'll find someone who you're like, I know that, like, I like that person. I've seen that person. I believe in that person. And then you get to a spot where you're comfortable investing. And like I did, I just dipped my toe in the water. I saw the results. I said, wow, all right, this is cool. I can go a little bit further. So for me, that was my path. I had to get away a little bit. Perfect example. I had a 3.5-year-old, and my daughter was actually, when I flew to that event, my wife was pregnant. And my son was 3 at the time. He was almost 3 at the time. So I left them home alone in a house that wasn't done, but I said, I've got to do this. But it's changed our life. It's like 3 days that changes the next 30 years of your life. Like, go do it. Don't even hesitate. Don't second guess it. Just go do it, because it's going to change your life. Just go do it.
Yeah, no, I think that's great advice. Well, Stephen, I've really appreciated our time together. I think you've added a ton of value to the listeners. Maybe just repeat one more time where they can find more about you, and we'll kind of leave them with that.
Absolutely. Keith, thank you so much for having me. I really enjoyed being with you today. Go ahead and check out the investment group. We're sustainablecapitalinvestments.com. Like I said, go hang out in our resources library, sign up for our newsletter, sign up for our webinars. You can even schedule a call with me, hop on a call with me, get to know me. If there's anything I can do to help any of your listeners out, I'm happy to get in a phone call with them.
Fantastic. All right. Thank you, Stephen.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.